Welcome to the Deep Dive. Today we're taking a close look at Dicom Industries. Their second quarter fiscal 26 results just came out August 20th.
Yeah, and Dicom is, a really key player in building out the digital infrastructure across the U.S. This call, it gave us some fascinating insights. Performance now, sure, but also, crucially, where they see growth coming from, especially with all the buzz around AI.
Definitely. It feels like everyone's talking about AI infrastructure builds right now.
Absolutely, and Dicom's right in the thick of it. So while the headline numbers maybe looked a little mixed at first glance, digging deeper shows some really strategic moves they're making. Positioning for fiber demand, yes, but also this, explosive AI data center build-out.
Okay, let's unpack those numbers then. What did we see for Q2?
So they reported earnings per share, EPS, of $3.33. That's both GAAP and non-GAAP.
And that was a beat, right? Consensus was lower, around $2.92.
It was a solid beat, yeah. But then you look at revenue. Came in at $1.378 billion.
A slight miss there compared to the $1.41 billion the street expected.
Exactly. Even though, it was still up 14.5% compared to last year, which is objectively pretty good growth.
Still strong growth, yeah. But that miss, it definitely got the market's attention early on.
It did. The shares dipped in pre-market, opened lower, though they did claw back some of that during the day, finished down, about 4.5%?
Something like that. Shows how sensitive the market is to that top line, doesn't it?
It really does, even when profitability looks really good. And it did here. Adjusted EBITDA was $205.5 million.
Which is a big jump, nearly 30% year over year.
Huge jump. And the margins expanded, too, by 175 basis points, up to 14.9%. That really speaks to how well they're running the business, the operational side.
So yeah, maybe mixed on the surface, but strong underneath. And cash flow?
Operating cash flow was $57.4 million. And they improved their DSOs, day sales outstanding.
Right, how fast they get paid.
Exactly. Down 9 days year over year to 108 days, so they're managing that working capital more tightly, too.
Okay, good snapshot. So beyond the numbers, what did management actually say was driving that strong EBITDA and the margin expansion? What's the secret sauce there?
Well, they pointed mainly to operating leverage, getting more profit out of each dollar of revenue as they scale, and also just increased efficiencies out in the field. They really hammered home this focus on operational discipline.
So it's not just a one-off thing?
Doesn't sound like it. They mentioned they've been seeing margins improve over time, and they think there's still more room to run there, more improvement possible.
That's significant. Okay, let's zoom out a bit. Their traditional business, fiber to the home, FTTH, still looking strong.
Oh, absolutely. Incredibly robust. Management highlighted that their customers' build plans now add up to over 125 million potential connections or passings.
125 million.
Wow. And get this, over 50 million of those are new plans added just in the last 16 months or so.
So the pace is actually accelerating.
Seems like it. And a big piece of that was AT&T upping its target to 60 million passings. That came after they bought a big chunk of Lumen's consumer business. It just shows the sheer scale. These projects are massive and ongoing.
And Dicom isn't just sitting on old contracts, they're winning new stuff.
Precisely. They've been busy extending existing deals, but also locking down completely new fiber-to-the-home markets with multiple customers, broadening their base.
Makes sense.
They did acknowledge, though, that the timing of these big builds can be a bit lumpy. Quarter-to-quarter variations happen, but the long view, huge opportunity. They see this extending well beyond 2030. It's like a multi-decade cycle.
Okay, and this is where maybe things get really interesting beyond the fiber-to-the-home story. The AI data center build-out. They put a lot of emphasis on that. What's the scale we're talking about here?
This is potentially huge, a major new growth area for them. Dicom's estimate is an addressable market just for the outside plant network stuff for data centers of over $20 billion.
$20 billion. Over what time frame?
Just the next 5 years. Yeah. And think about what's driving it. Some analysts reckon U.S. power demand just for AI data centers could jump like 30 times by 2035.
30 times? That's staggering.
It is. From maybe 4 gigawatts now to potentially 123 gigawatts. That means over $1 trillion in data center investment in the U.S. alone. And a huge chunk of that requires serious fiber infrastructure, high density, low latency, diverse paths, all the stuff Dicom does.
So it's not just connecting homes anymore, it's connecting these massive AI brains. And Dicom's already winning work with the big hyperscalers.
They are. They mentioned securing more of these inside defense awards. That's work directly on the data center campus.
Okay.
And Significantly, in Q2, they also won a separate service and maintenance agreement with a different hyperscaler.
Ah, so not just building, but maintaining too. That's interesting.
Very interesting. It's a new service line separate from their usual carrier work.
Yeah.
It means recurring revenue directly from the tech giants themselves.
That sounds like a sticky business.
Potentially very sticky. They expect the actual construction of these big data center networks to really start ramping up in calendar 26 and then accelerate significantly from 27 onwards. We're just at the beginning.
So build it and then maintain it. That maintenance piece, how core is that to their strategy overall?
It's fundamental. It provides stability, recurring revenue streams that balance out the more project-based construction work. And as they build more, naturally, the opportunity to maintain it grows. Their nationwide footprint, being able to respond quickly across all 50 states, that's a real edge there.
Okay. What about other areas? Wireless and the elephant in the room, BEAD funding.
Wireless, there's some optimism, equipment upgrades, network densification, partly driven by new spectrum, partly by AI workloads needing more capacity at the edge. Their current work replacing equipment is actually doing better than they expected.
Good sign. And BEAD, is that finally starting to flow?
Well, management acknowledged the potential is huge, obviously, billions of dollars. But, and this is key, they have not put any BEAD revenue into their forecasts yet.
Ah, okay. So it's pure upside if and when it hits.
Exactly. They're being cautious, waiting for states to finalize plans and get approvals. Prudent, probably, given how these things can sometimes take time.
Makes sense. Which brings us to the guidance. They reaffirmed their full-year outlook, even with that Q2 revenue miss. That feels pretty confident.
It does send a strong signal. They stuck with the full fiscal 26 range, $5.29 billion to $5.425 billion in revenue.
Yeah.
And for Q3, they're guiding to revenue between $1.38 and $1.43 billion, adjusted EBITDA $198 to $213 million, and EPS $3.03 to $3.36.
And that confidence comes from?
The backlog, mainly. It's huge, $8.7 billion total backlog.
Yeah.
And $4.6 billion of that is expected to convert to revenue in just the next 12 months.
Those are big numbers, up significantly year over year, right?
Yeah, up 16.9% and 20.2% respectively. So they have pretty good visibility into the near-term workload, despite the project timing lumpiness.
And wasn't there a big contract win after the quarter closed?
There was. Really good timing for the call. Shortly after Q2 ended, they secured a big new multi-state deal. Covers both service and maintenance and new fiber-to-the-home builds.
So more fuel for the backlog in Q3.
Exactly. That'll show up in the next report and should start contributing meaningfully to revenue in calendar 26 and fiscal 27. Just reinforces that demand picture.
Okay. Any help from outside forces? Policy, taxes?
Actually, yes. That big tax bill that passed recently, the Tax Relief for American Families and Workers Act.
Right. The one that brought back a 100% bonus depreciation.
That's the one. And immediate R&D expensing, too. That's expected to boost cash flow for Dycom's customers, which should encourage them to spend more on capital projects, like fiber broadband.
So an indirect benefit for Dycom.
Indirect, but potentially significant. And a direct benefit, too. Dycom expects about a $50 million boost to their own free cash flow this fiscal year from lower cash taxes because of that bill.
$50 million is not small change.
Definitely not. Plus, there are ongoing efforts to streamline permitting for infrastructure projects, which could eventually speed things up and maybe lower costs, more tailwinds.
Okay, so putting it all together, the market reacts, maybe overreacts, to a slight revenue miss. But management is pointing to huge long-term trends, operational strength, a massive backlog, and even some policy help. How should investors think about this?
Well, it highlights that classic tension, doesn't it? Short-term noise versus the long-term story. The market saw EPS beat, revenue miss, and got a bit spooked initially. But you have to remember, especially with these huge infrastructure projects, there's often a lag. Customer commitments today might not fully hit Dycom's revenue line for, 12, maybe 18 months.
Right. The market isn't always patient enough to see that play out.
Exactly. So management really tried to paint that bigger picture. The fiber cycle is still strong. The AI data center opportunity is enormous and just starting, and their operational execution is improving. Reaffirming guidance was a key part of saying, look, we're confident despite the quarterly timing issues.
And it seems like maybe the market started to listen as the trading day went on.
Perhaps. The recovery off the lows suggests some folks started looking past the immediate miss towards that backlog and the future potential, especially in AI.
And they aren't overly reliant on just one or two customers, are they?
No, they made a point of highlighting that.
Okay.
AT&T and Lumen are big, yes, over 10% each. But they have multiple other customers over 5%, Brightspeed, Charter, Comcast, Frontier, Verizon. It's a pretty diverse mix.
Spreads the risk.
It does. It fits their whole scale and scope strategy. Grow organically, make smart acquisitions, have that broad service footprint. It helps them solidify their position as a leader.
How are they thinking about using their cash? Growth, buybacks, M&A?
Priority number one, they said, is funding organic growth, making sure they have the capacity to meet this demand wave. But they're also definitely interested in M&A if the right opportunities come along, ones that fit strategically and culturally. And they'll do share buybacks when it makes sense.
And improving cash flow helps fund all that.
Absolutely. That focus on DSOs and working capital management supports everything else.
So summing it up, there may be some bumps in the road quarter to quarter because these projects are just so massive and complex, but the overall direction seems clear. Massive demand for digital infrastructure, and Dycom is positioned right in the middle of it.
That seems to be the core message, yeah. Building the foundation for connectivity and AI for years, maybe decades to come.
Okay, let's shift gears. It's time for our This Is Not Financial Advice segment. Time to put on our imaginary hedge fund analyst hat. What's the outrageous but plausible trade idea based on this Dycom call?
All right. Today's pitch is straightforward. A high conviction long on Dicom Industries, ticker DYY. We're arguing the target price should be substantially higher than where it is now. Why? Because the market got hung up on a, frankly, pretty small $30 million Q2 revenue miss. That gives us an entry point into what we see as a generational infrastructure story at a discount.
So buying the dip, essentially.
Buying the dip, yes, but with a very strong underlying thesis. The long-term drivers FTTH, yes, but critically, this exponential AI data center build-out for the outside plant network. These are just too powerful to be stopped by near-term project timing wiggles.
You think the market's underestimating that AI angle?
Massively underestimating it, or at least underappreciating how Dycom benefits. We're betting their proven operational efficiency, those expanding margins we saw, will continue. That means strong, durable cash flow growth. That $20 billion 5-year market estimate for AI data center networks, probably conservative. And the real ramp starting in 26-27 is the key catalyst people are missing.
Plus the other goodies.
Right. Add in the $50 million cash flow boost from tax changes, that big contract they just won after Q2, the potential BEAD upside that isn't even in the numbers yet. You've got layers of potential positive surprises. This isn't just a construction company. It's a bet on the entire digital future, run by the market leader with the scale and expertise needed. The current share price just doesn't reflect that unique position for a build cycle that could last decades.
A compelling case. Okay, let's wrap up our deep dive on Dycom's Q2 fiscal 26 earnings. The main takeaway looks like strong underlying performance, really impressive efficiency, driving record profits, and it's all happening against this backdrop of just massive, accelerating demand for digital plumbing.
Yeah, the market hiccuped on the revenue miss, sure, but management laid out a really clear path forward, focusing on those huge multi-year growth drivers in fiber and especially AI data centers. Their backlog is solid, they're making smart moves, they're managing the business well. It all points to confidence in hitting their targets for the year.
It really is a story about a company positioning itself for the long haul in a market that's fundamentally changing and growing.
Definitely. Plenty to think about there as you watch this whole digital infrastructure space evolve.
Well, thank you for tuning into the deep dive. Just a reminder, everything we discussed here is for educational purposes. It's definitely not financial advice. Always do your own research. We really appreciate you joining us, and we'll catch you next time for another earnings call breakdown.